Bruce, let me ask you, when do you think, at least from a corporate behavior standpoint, we start to see some relaxation of rules? Even in the last half hour, Walmart, which is obviously headquarters nowhere near Seattle, has instituted some travel restrictions.
Well, that's certainly going to impact the markets. But when we entered early January, there was a lot of optimism that the global economy was improving. We had 3 straight months of improving PMI numbers. The labor markets in the U.S. were actually getting better. And earnings estimates for growth for the second half of the year were the consensus view. And then the virus hit, and the initial reaction by the markets was cavalier. The markets continued to go higher. But once the virus news hit that it was spreading outside of China, suddenly corporations like Apple were downgrading earnings, and then we had a rush to safe haven assets like treasuries and exit from risk assets. The key question really is the virus going to be a temporary impact on the economy, or is it going to have a more lasting effect? And by that I mean into the second quarter and into the third quarter. And that's the reason why that uncertainty is causing the market to become unstable.
Is your outlook for stabilization in Q2?
Well, the 2 things I think have to happen here. One is we need to have evidence that the virus has been contained outside of China and that the global economy has stabilized. But from a technical perspective, we had a big break in the market on Friday, the 28th of February. We had a very oversold condition. Then we've had a reflex rally here this week. Typically, 80% of the time, the markets will go down and retest the lows, which were around 28.50. If that retest is successful, we should see the markets explode to the upside in terms of breadth, with 2 days where upside volume exceeds downside volume by a ratio of 10 to 1 or more. If those 2 things surface, then we believe that the worst of the decline is over and that the long-term trend of the market can resume. But we're waiting on those 2 events.
Matt, I realize stocks are down today, but we've had these dramatic moves in both directions in recent sessions. It has not been confirmed by either the Treasury market or the gold market. What are those asset classes signaling right now, and how important is it to see more correlation between some of these different markets in general to see something like a more sustained rally?
Yeah, no, that's a very good question. Go ahead.
Matt.
I'm sorry. We're really watching the credit markets as well. I think that's a strong indicator when you talk about the other markets to watch. And spreads there have actually been pretty well contained and pretty orderly, much more so than the equity markets. So that gives us some comfort. But I think backing up to the big picture, there is a wide range of uncertainty, especially in the short run. But our main message is that when we get through these episodes and we're a year out, markets are typically higher from either a virus epidemic or episode like this, or just a volatility spike that we've had. So if you can be a long-term investor, we are, then this is an opportunity to take the long view. And of course, there'll be, because of the uncertainty, there'll be some volatility in the short run. We could go down further, but in the long term, we feel we'll be in a stronger position and we'll be higher in markets.
So, Matt, in light of that, if you're a longer-term investor, would you be buying into pockets of the market right now at these levels, and given the fact that there is so much volatility?
Well, we came into the year at pretty high valuation levels, and some of that's been corrected. We'd be waiting for lower levels to really start buying, especially given the near-term uncertainty, and you may get an opportunity if there are lower prices or more volatility coming in. But I think there are sectors you can start looking at now, such as dividend-paying sectors, especially with lower rates. Those are going to be more resilient in the face of volatility. So we like that sector now, and you can start nibbling there now or averaging in, but slowly, patiently, and be disciplined, but prepare for more volatility. This is going to be a wild ride for some time.
Finally, Bruce, I've seen a bunch of analogs to 2011 when we got the initial correction starting in August. We chopped around for a couple of months and then eventually had that pretty dramatic October low. Is that a fair comparison to where we are today?
Yeah, I think that is a fair comparison, simply because historically, after you've had this kind of volatility, the market tends to have a reflex rallies. Then you have a retest of the lows, and you may have several retests. And that's the reason why we have suggested to our clients that they don't buy this dip until we get evidence that the virus has been contained and that the technical condition of the market has improved. And by that we mean we need to see a breath thrust to break this downside momentum. And once we get a day or two of upside volume exceeding downside volume by a ratio of 10 to 1 or more, that would be evidence that a bottom is in place. But we're waiting on that to happen.